Navitas Semiconductors is currently trading at $10.48 per share, showing a strong upward move of 4.05% in today's session on Monday, January 12, 2026. This intraday performance is catching plenty of eyes because the stock actually opened the day at an even $10 and dipped as low as $9.55 before finding a massive wave of buying pressure that pushed it to its current daily high. If you are watching this on a real-time feed or through your Robinhood app, you are seeing a volume of nearly 10 million shares already changing hands, which is a significant uptick compared to the quiet sessions we saw toward the end of last year. Most people looking at their screen right now see a small-cap chip company having a good day, but the reality is far more complex than a simple price spike. The market is starting to price in a reality that many retail investors have completely overlooked, which is that Navitas is no longer just a company making fast chargers for your phone. They have quietly positioned themselves at the core of the high-voltage infrastructure required for the next generation of artificial intelligence data centers. This is the curiosity loop that is starting to drive institutional interest. While everyone is busy chasing the latest peak in NVIDIA stock or wondering if Apple stock has any more room to run in the handset market, a massive shift in how electricity is handled in massive server farms is creating a vacuum that Navitas is designed to fill. The common belief among those who follow small-cap semiconductors is that Navitas is a risky, loss-making venture that is too dependent on the Chinese consumer market. For a long time, that narrative was mostly true. Their books were heavily weighted toward mobile chargers and consumer electronics, sectors that have been notoriously volatile and low margin. However, the contrarian view, and the one that is likely driving this 4% gain today, is that the company has undergone a massive structural shift. They are moving away from those low-margin products and focusing almost entirely on high-power systems. This is where the expectation versus reality tension becomes most visible. Investors expect a struggling hardware company, but the reality is a firm that has just integrated itself into the 800-volt power architecture that is becoming the standard for massive AI installations. When you look at the recent stock movement, you can see this tension playing out in real time. We have seen 10% and 15% daily swings over the last 2 weeks, which often indicates that large players are accumulating positions before the broader market catches on. If you are using something like Interactive Brokers trading tools to look at the dark pool activity, you would notice that institutional inflow has been steadily rising, even while the retail sentiment remained lukewarm. This recent momentum isn't happening in a vacuum. The broader semiconductor sector has been navigating a difficult period of high interest rates and shifting demand, but Navitas has managed to decouple itself from the pack lately. While many investors are looking for investment help to understand why their broad market ETFs are stalling, individual names like Navitas are benefiting from specific catalysts. For instance, the recent partnership with Global Foundries to move production of gallium nitride chips to U.S. soil is a massive deal for long-term stability. This moves them away from the geopolitical risks that have haunted the chip sector for years. If you are doing your own self-investing or using Fidelity Investments to manage your portfolio, you have to look at these supply chain shifts as a form of de-risking that doesn't show up on a standard balance sheet immediately. The market is beginning to recognize that having a domestic manufacturing partner for next-generation power chips is a major competitive advantage when you are trying to win contracts with large U.S. cloud providers. When we talk about the technicals of the move today, it is important to look at the volume. The fact that we are seeing over 9 million shares traded before the halfway point of the New York session suggests that this isn't just a few retail traders on a Robinhood stock trading spree. There is significant weight behind this move. The stock has been trending above its 50-day and 200-day moving averages, which is a classic bullish signal that often attracts quantitative funds and algorithmic trading platforms. For those who use SoFi Invest or other popular investing sites, these technical indicators are often the first thing that triggers a buy signal. But beyond the charts, the real story is about the transition from 48-volt to 800-volt power systems in data centers. Current systems are hitting a wall because they simply cannot handle the heat and power requirements of the newest AI processors. Navitas produces gallium nitride and silicon carbide chips that allow these systems to run much cooler and with much less energy waste. This is why their inclusion in the newest power ecosystems is such a big deal. If we look at the institutional side of things, the data is telling a very specific story. Large firms like Vanguard and BlackRock have been increasing their stakes in Navitas, often holding these shares in various Fidelity ETFs or total market funds. Even though the company still reports a net loss, these big players are looking at the forward-looking revenue growth in the high-power segment. It's a classic case of the market valuing future potential over current earnings. If you are looking for investment help to decide where to put your capital, this institutional backing is usually a sign of a high-conviction long-term play. It is very different from the speculative frenzies we often see in the Robinhood crypto markets. This is a fundamental bet on the physical infrastructure of the internet. Now, let's step back and look at what Navitas actually does for those who might be new to the name. They are a leader in what's called wide-band gap semiconductors. Instead of using traditional silicon, which has physical limits on how much power it can handle, they use gallium nitride and silicon carbide. These materials are much more efficient, which means they can be smaller, lighter, and run at higher temperatures without failing. Their business model has historically been about selling these chips to manufacturers of laptop power bricks and smartphone chargers. That was Navitas 1.0. The new strategy, which they call Navitas 2.0, is about taking that same technology and scaling it up for much bigger things. Think about electric vehicle onboard chargers or the massive power supplies that feed the racks in a Google or Amazon data center. This shift is why the stock is being compared to much larger entities. While you might hold Tesla stock for the vehicle exposure, Navitas is a way to play the power efficiency of the entire EV and AI sectors combined. Looking at the older reports from late last year, the company did see a drop in revenue because they were intentionally cutting off their low-margin business. This is where many investors got spooked. They saw a 50% drop in revenue and thought the company was dying. In reality, management was clearing the decks to make room for the high-power contracts that are expected to start shipping in volume later this year and into 2027. This is the essence of the expectation versus reality gap. The expectation was a failing consumer chip company. The reality is a leaner, more focused power technology firm waiting for its primary market to mature. If you are managing an individual brokerage account or using the Fidelity mobile app to track your positions, these are the types of strategic pivots that require a lot of patience. In the future, the catalysts for Navitas are very clear. They have a major presentation coming up at the Needham Growth Conference in just a couple of days, where the CEO is expected to provide more details on their 800-volt product samples. If those samples are well received by the major cloud providers, we could see a series of design wins that would fundamentally change the company's valuation. There is also the potential for more partnerships like the one they have with Cyient in India. India is becoming a massive market for electric mobility and local data center growth, and Navitas is getting in on the ground floor. If you are using SoFi Active Investing to find growth stocks, these international partnerships are a key metric to watch. They provide a diversified revenue stream that isn't solely dependent on the US or China. Of course, there are risks to this outlook. The company is currently trading at a price-to-sales ratio that is significantly higher than many of its peers. This means the market has already priced in a lot of success. If there is a delay in the adoption of 800-volt architecture, or if a larger competitor like Broadcom or even NVIDIA stock decides to move more aggressively into the power management space, Navitas could see its margins pressured. Also, the company still needs to prove it can reach profitability. They have a healthy cash balance for now, but they are still burning money to fund their research and development. If you are a fan of online investing through platforms like Interactive Brokers, you know that the higher-for-longer interest rate environment makes it very expensive for loss-making companies to raise more capital if they run out. Despite these risks, the momentum we are seeing today is a sign that the market is willing to look past the short-term hurdles. The intraday move to $10.48 isn't just a random fluctuation. It is a response to a growing realization that power efficiency is the next major bottleneck in the AI race. We have spent the last few years focusing on the processors and the software, but we are now entering a phase where the physical ability to power these machines is what matters most. Comment below how many shares of Navitas Semiconductor you currently hold, or if you are waiting for a better entry point. To summarize the central insights of today's movement, Navitas is currently navigating a high-stakes transition that the broader market is only just starting to understand. The expectation was that the company would struggle as it walked away from its core consumer business, but the reality is that this move has allowed them to capture a much more valuable position in the AI infrastructure supply chain. By focusing on high-voltage systems and domestic manufacturing partnerships, they have de-risked their business model in a way that many small-cap peers have failed to do. The stock price today reflects a growing confidence that Navitas will be a key player in the physical build-out of the next decade's computing power. While the high valuation and lack of current